Welcome to this explainer. Let's just jump right into a fascinating paradox playing out in the AI infrastructure space right now. We're looking at Marvell Technology, a company that's become a huge talking point for investors trying to navigate the artificial intelligence boom. It's a classic tale of high risk and high reward, set right in the middle of one of the absolute fastest growing industries of our time.
Section 1. The AI Stock Paradox. A Market Disconnect.
Now, check out this massive disconnect between a skyrocketing stock price and collapsing net profits. In the last year, Marvell's stocks shot up over 200%, literally beating Nvidia in some portfolios, which is just wild. But right beneath that hype, their actual net profits crashed by 80% year over year. That is a staggering drop for a company whose stock is on absolute fire.
So it all begs the ultimate question. Is Marvell the hidden giant of the AI revolution, or is this just a bubble waiting to pop? I mean, are investors paying a premium for pure hype, or is there some strategic genius behind this valuation that we need to understand?
Section 2. Fixing AI Bottlenecks. Let's look at what Marvell actually does. To really get Marvell, you have to think of AI data processing like a massive, high-speed highway. Nvidia, they're building the insanely fast sports cars. Those are the high-powered GPUs. But what happens if those fast cars hit a dirt road or a massive traffic jam? They slow down, right? Well, Marvell builds the interchanges, the on-ramps, and the traffic management systems that ensure those fast cars can actually keep moving at top speed.
And big tech is paying out billions for 3 specific infrastructure pillars to keep their massive AI operations running seamlessly. First up, you have custom silicon, or XPUs. These are tailor-made chips for the exact needs of cloud giants like Amazon and Microsoft. Second, networking and interconnects. Basically, the tech moving huge amounts of data between the chips. And third, optical tech. This is truly fascinating stuff. They're actually using light instead of electricity to transfer data. That is absolutely vital for keeping the insane heat down and speeds up in those massive AI data centers.
Furthermore, they just launched this new memory disaggregation tech, reinforcing their critical position in business-to-business AI infrastructure. You know, you're obviously not going to find this sitting on a Best Buy shelf, but it is the exact invisible infrastructure keeping the AI models we all use every single day from crashing.
Section 3. The bull case. Let's look at why you might buy. So, the bull case is really built on this exploding Nvidia-level revenue growth trajectory. In the first quarter, revenue grew over 27% year over year. But here's the kicker. Management is pointing toward nearly 40% growth this fiscal year and a massive 45% growth next year. That's exactly the kind of aggressive revenue scaling that absolutely grabs investors' attention.
Plus, Marvell is basically getting a cut of every server rack out there because their custom chip programs are so deeply tied to hyperscalers spending massive amounts of capital. We're talking about Amazon, Google, and Microsoft spending over $200 billion collectively on AI infrastructure. Because Marvell is so deeply integrated into their systems, as these giants spend, Marvell just automatically benefits.
And bulls will argue that hitting this massive $16.5 billion revenue target by fiscal year 2028 will eventually make today's high valuations look incredibly cheap. It's kind of like looking back at Amazon in its early infrastructure building days. The argument here is simple, right? Tolerate the high prices and low profits today because they're spending heavily to build the dominant infrastructure of tomorrow. Once that's built, the big profits will follow.
Section 4. The bear case. Let's explore why you might want to sell or just wait.
Okay, but the grim reality for the bears lies in some incredibly stretched metrics. A forward price-to-earnings ratio of 58 is sky high, and a price-to-sales ratio of 24 means investors are paying an enormous premium. And look at those profit margins, dropping from 18% down to a measly 1.43%. I mean, those are margins literally thinner than a silicon wafer. Bears argue this isn't a healthy growth company. It's a company burning massive amounts of cash just to stay relevant in the AI race. A single earnings miss here, and analysts warn we could easily see a 30% correction in the stock price.
Bears also point out some pretty significant execution risks. Think about it. Marvell's success is tied heavily to just a few hyperscalers. What happens if Google or Amazon suddenly decides to design all their own chips internally to save a few bucks? Marvell loses all its leverage. Add to that the fact that both the CEO and the COO recently sold shares. Now, yes, these were pre-planned sales, but when a stock's valuation is this stretched, you really have to ask yourself, do optics matter immensely to the market right now? For sure they do.
Section 5. The final verdict. Buy, sell, or hold.
So how does all of this actually fit into your portfolio? Look, Marvell is a high-conviction, long-term AI bet that requires a seriously strong stomach for volatility. It's definitely not a safe value play. You're looking at buying if you firmly believe AI infrastructure spending isn't just some passing trend, but a multi-year supercycle. And you're totally okay with seeing your portfolio swing up and down 20 to 30%. On the flip side, you probably avoid or trim your position if you believe the market has already priced in sheer perfection. If there's a macro shock, say interest rates staying high or cloud spending slowing down even a fraction, a stock price for perfection like Marvell is going to get hit hard. The most immediate catalyst to watch for this stock is the August 27 earnings report. Beating guidance gives the win to the bulls, while a downgrade hands the reins right back to the bears. In a valuation environment this tight, guidance is absolutely everything. You'll want to keep a hawk's eye on those numbers.
So what's your take? Are you investing in the vital, invisible infrastructure of the future, or are you just buying the top of a hype cycle in an unpredictable economy? As you do your own research, keep that question in mind and never bet more than you can afford to lose. Thanks so much for joining me for this explainer. I'll catch you next time.